All right, let's dive into one of the biggest, oldest debates in the entire world of investing. Are you supposed to be a company detective, digging through financial reports to find out what a business is really worth? Or are you a market psychologist, trying to read the emotions of the crowd just by looking at a price chart? Seriously, people have been fighting over this for decades, so let's break it down. At the end of the day, it all comes down to this one question. What is actually moving the market? Is it the hard numbers, the balance sheets, the profits, the actual health of a company? Or is it just raw human emotion? All that fear and greed playing out in real time on a chart for everyone to see?
For pretty much as long as markets have existed, investors have lined up in two very different camps. You've got your fundamental analysts on one side, they're the detectives, and on the other, you've got your technical analysts, the market psychologists.
And these two approaches, honestly, they could not be more different. It's kind of like the classic story of the tortoise and the hare, right? Fundamental analysis is the tortoise. Slow, steady, doing that deep detective work. It's all about the long term and finding a company's real intrinsic value. Technical analysis, on the other hand, is the hare. It's fast-paced, focused on short-term price patterns, and it runs on the belief that all that fundamental stuff is already baked into the price anyway. Okay, so let's start with the fundamental camp. Their entire mission, their whole reason for being, is to answer one single question. If you ignore all the day-to-day noise, what is this business actually worth?
So yeah, the official definition says it's a deep dive into a company's total health. You're looking at, well, everything. The balance sheets, the income statements, the industry it's in, what the whole economy is doing. The goal is to figure out if the market has it right. Is this stock a bargain right now, or is it way overpriced?
And how do they figure that out? Well, they get their hands dirty with some key numbers. Of course, they're looking at earnings growth. That's a given. But they're also digging into things like return on equity, which basically tells you how good a company is at turning investors' money into more money. They're literally giving the company's financial engine a full checkup. But, and this is a huge but, here's the catch. A company can have perfect fundamentals, just amazing numbers, and the stock can still go nowhere or even down for a really long time, just because the market isn't feeling it. This means fundamental analysis is fantastic at telling you why a stock is a good company, but it can be absolutely terrible at telling you when to buy it. And that problem, that critical timing problem, is exactly where the technical analysts come into the picture. See, they don't really care about the company's health report. They're obsessed with what the market is thinking right now. The core belief of technical analysis is pretty simple. Everything, and I mean everything, all the news, all the reports, all the hope, is already reflected in a stock's current price. They believe history repeats itself because human psychology never really changes. So, by studying chart patterns, you can read the market's mood and make a pretty good guess about what's coming next. Now, let's look at their playbook in action on this chart. They use tools like moving averages to get a feel for the overall trend. They use other indicators, like the RSI, to see if a stock might be overbought or oversold. And others, like the MACD, measure the momentum or the oomph behind a price move. It's all about trying to pinpoint that perfect moment to make a move. But here's the major weakness, right? It's kind of like trying to drive a car by looking only in the rearview mirror. A chart pattern can look absolutely perfect, but then, bam, a surprise bad earnings report hits and the whole thing just falls apart. It tells you a story about what has happened, but it can't predict a sudden shock out of nowhere. So, here we are. We've got two really powerful systems, but both have a big flaw. One tells you what to buy, but not when, and the other tells you when to buy, but not what. So it kind of makes you wonder, what if the whole debate is wrong? What if you're not supposed to pick a side? What if you could just use both? A trader on Reddit summed this up perfectly. Think about it this way. The fundamentals are like your destination on a map. They tell you where a stock is probably headed in the long run. But technical analysis, that's your real-time GPS, telling you exactly when to get on the highway, when to switch lanes, and when to get off. And this idea of blending the two isn't some new fad, not at all. In fact, one of the most legendary, time-tested investing strategies ever created is built on this exact principle. I'm talking about William O'Neill's CAN-SLIM system. Let's just break it down really quick. The C and the A are all about strong earnings. That is pure fundamental analysis. And is for something new, a new product, new CEO. That's a fundamental catalyst. But then you look at S, L, and M, that's all technicals. It's about supply and demand, price leadership, market direction. It is the perfect marriage of the two disciplines. Now fast forward to today, and modern traders are using the exact same logic for shorter-term trades. Step 1. Find a company that has a big fundamental event coming up, like an earnings report. Step 2, watch the chart like a hawk for a clean technical pattern to form. The real magic, the highest probability trade, happens at the exact moment those two things converge. So if that's what human traders are doing, what happens when you throw artificial intelligence into the mix? Well, this is where things get really, really interesting. Today's AI is basically taking this hybrid approach and putting it on steroids. A 2024 research paper laid out how one of these AI systems works, and guess what? It doesn't pick a side. It crunches all the standard technical indicators from the charts, sure, but at the exact same time, it's scanning thousands of news articles to figure out the sentiment of the market, which is a modern way of doing fundamental analysis. Then it uses machine learning to weigh everything and spit out a single trade signal. And the results? Well, they're pretty staggering. The hybrid AI strategy returned over 135%, completely crushing a baseline strategy that only made about 8.6%. But look closer at the Sharpe ratio. That number tells you how much return you got for the amount of risk you took. At 1.68, it's more than triple the baseline. That means it wasn't just making more money, it was making smarter, more efficient bets.
And to put that performance into perspective, this AI strategy didn't just beat some simple model. No way. Over the same period, it blew past the major market indexes, the S&P 500, and even the tech-heavy NASDAQ 100. When you see numbers like that, it's pretty hard to argue against the hybrid approach.
Okay, so we've covered a ton of ground. What does this all mean for you? What's the one big idea you should walk away with from all this?
It really boils down to this. The whole debate is based on the wrong question. The goal was never to pick a side. The smartest approach is to use fundamental analysis to find what to buy, to build your shopping list of great companies. And then you use technical analysis to figure out when to buy it, to wait patiently for that perfect moment when the market's on your side. And I want to leave you with this one last powerful thought from that Reddit user. In the end, being a successful investor or trader isn't about being loyal to one system or one dogma. It's about being flexible. It's about using every tool you have. And most of all, it's about being able to adapt to whatever the market is telling you right here, right now.